Good afternoon, Peter. How are you?
It's good evening. It's actually good morning here, Viraj. I'm very good. You?
I apologize, but yes, it is morning now, huh? So what, 1 a.m.?
It's 1 a.m. Yes, yes. This is kind of
Wow.
normal for me.
Well, I hope you got your coffee and your espresso and whatever else you need to stay awake. But we've got a very interesting segment today. Going to be talking about trading the open. So trading when you shouldn't. Keys to successfully trading the open. That's going to be the topic for today. But Peter, anything you need from me before I hand it off to you? I'm just going to post here in the lounge real quick. If you want to view Peter Davies' charts and see the presentation that he's going to present in just a moment, just click this link here that I'm posting in the lounge, join.me/topsteptrader. So I'm in there right now. I see about 26 other people. It looks like some people are rolling in. So looking good to me, Peter. You need anything from me before I hand it off to you?
No, I'm good, Viraj. I'm good.
All right, so I'll be here on the sidelines. If you need anything, just chime in. But other than that, all you, buddy.
Absolutely. Thanks a lot. Okay, so thanks everybody for turning up. This is actually a webinar I put together probably August, end of August, October last year. And we were going to do the webinar in October, but my father had a heart attack. And so we kind of delayed it, and we're doing it now. So some of the slides, some of the screenshots I'm going to show you are a little bit older in terms of being from the summertime, but it's just a matter of that's when I did the slides, didn't really want to do the screen images again. So today we're going to discuss trading the open. Now that's not the opening range, but the open itself, and it's not the first 90 minutes we're talking about or 30 minutes, but the first few minutes. In some cases, taking trades within the first couple of minutes of the market opening. Now, as with any trading opportunity, there's more than one way to approach this in terms of trade management, and so we'll discuss that portion too. But this opportunity itself, it's often available within seconds of the open. Now, this opportunity is one that you will be able to go away and see quite clearly for yourself. So this webinar isn't I'm going to show you half of it and then sell you the other half. This is going to be complete. It's something you can take away, look at for yourself, take time over the next few weeks to watch for the things I'm going to discuss, and you'll start to see this for yourself. Now, trading this early on does fly in the face of a lot of conventional trading wisdom that specifically tells us to avoid trading at this time, and many people, rightly so, wait for the first 15 minutes to pass to let the market show its hand before they consider placing a trade. And the reasons, the reasons that I hear a lot, usually given for not trading the opening minutes, are first of all, it's too volatile. And it certainly is volatile. It's going to swing one way and then the other very quickly, but that doesn't necessarily mean it's too volatile to trade. It just means, yeah, it's a volatile time. Also, there's no high or low range for the day yet. So the previous day's range extremes might be quite far off. So there's no reference points for the day to play off. Now, for index futures, institutional equity trading is just starting. So I'm looking at the ES. We don't have to do this with the ES. That's the market I'm going to show you today. So the stocks and the futures need to kind of realign, and that arbitrage trading kind of needs to bring everything back into balance. So on days when the ES opens 50 points down, it's sort of a valid point that we need to kind of rebalance the markets, but most of the time it's not really going to affect this setup. Now, I've actually seen one article that says that trading in the first 5 minutes of the market opening is nothing but gambling. It's a fool's game. So there's lots of other reasons out there too. If you go and Google trading at the open, you're going to see all this scary stuff of why you shouldn't do it. And it's not really terrible advice, it's just really generic advice. So many traders wait for the opening range to form and then they'll play off that. So the opening range is the first 30 minutes of trade, and a lot of traders will use that as a reference point, playing breakouts or reversals, and there's nothing wrong with that at all. But one thing is certain, you will be trading an area where a lot of other traders are looking to get positioned. So that's a common area to play off, and that means there'll be more predatory traders looking to take advantage of the additional stops built around those areas. Now, the big issue with don't trade the open though is just such a wide sweeping statement that appears to apply to all markets and every day as if it's written in law or something like that. Yeah, as we're going to see, there is opportunity there. But be sure, not all opens are equal. And why would they be? not all markets open in the same way. Why would they? So today I'll show you something that occurs on more days than it doesn't on the markets I trade. Something you can observe for yourself, and I would encourage you to do that over the coming weeks before deciding if and how you'd like to trade it. Now, it's a fairly simple setup, but it doesn't mean it's easy to trade. So it does take some experience of observing the opens to get to grips with the process of trading it. So don't start doing this on Monday. Now, before we consider the opportunity itself, we have to have a little bit of a think about what the open is. As many markets are actually open almost 24 hours a day. So if we look at the CME, their index futures products open at 5 p.m. Central Time. And anyone that's looked at the index futures at 5 p.m. Central Time will know the markets are really, really quiet then. And for many people that work office hours in the US, it would be an ideal time to trade when they get home in the evening, but there's just not a lot of institutional trading going on. And it's the lull between the close of the US banks to the open of the Asian banks. So even though the market opens at 5 p.m. Central, that's not what people generally refer to as the open. Now, the US futures markets remain quiet until the Asian banks and prop shops open. So we have an Asian open, and most US markets still remain fairly quiet at those times. And that's obviously, I'm out here in Asia, and it's not really good trading. Now, the US index futures are quiet, but some markets do have decent range and volume at those times. Crude oil isn't too bad. Japanese yen futures are both good examples of markets are more actively traded in the Asian session for fairly obvious reasons, right? Every region uses oil, for instance. Later in the day, we see European traders coming. So we get the Frankfurt Open, which tends to be a little quiet. So the Eurex is in Frankfurt, but generally speaking, in that first hour, there's not a lot of trading going on. So we get the DAX, the Eurostoxx 50s and the Bund are the biggest markets to start trading. So most of the time that first hour is pretty quiet, and there are exceptions to that. But for those that trade the German markets, you'll know that if nothing happens in the first 15 minutes, it's best to go and have a coffee and come back 45 minutes later, because that's when London markets open, and that's when we see the volume really pick up. Because the volume in London is massive. Forex, crude oil, euro futures, interest rate futures all see good volume and healthy ranges. The stock index futures in Europe aren't as volatile as the ones in the US, but arbitrage does keep them in line most of the time. So we have higher volumes and wider ranges once the London opens in comparison to the Asian session. And then we've got the US Open. So what is that? Well, for those of us trading index futures, some of us used to call the day session the pit session in reference to the times the CME trading floors opened. Now that most of the trading floors are closed, that doesn't make sense anymore. For index futures traders, the key opening time is when the US stock exchange is open, which is 9:30 a.m. Eastern time. Now, of course, there is a pre-market stock trading, but that's generally light. But it's 9:30 a.m. the stock market opens to all, and the volume in the corresponding futures markets increases dramatically. And more people, more algorithms come into play those markets. Now, trading floors haven't disappeared for all markets yet, but for a long time, their volume has been overshadowed by electronic trading anyway. So with trading, floors representing way less than 1% of trade in most markets, it's fair to say that in some markets it's more tradition than an underlying market that causes the volume to increase at the open time. So if you look at corn, for instance. So it's just accepted that the bulk of US institutional traders come in and start trading at those times. Now that could change over the coming years, and opening times could eventually become irrelevant for markets that don't have a compelling and large underlying cash market that hasn't open in the way the stock market does. But for now, that hasn't happened, and most markets have an open time where trading activity increases because a lot of institutional traders in the US start for the day, and in fact a lot of retail traders do. I don't start trading until the US market opens. I don't trade before 9:30 a.m. Eastern. Now, people still need to start their working day at some point in time. So I think, at least for the the medium term, we're still going to see those traditional opening times, because that's when people start working. They've got positions to put on at the start of their trading day, and that's why we see the rush of orders at the open. So it's the US day session open that most people consider to be the open and what I really consider to be open. So even so, whilst we may consider that US day session to be the open, many of these markets are open almost 24 hours a day. So what they haven't really done is just opened. They were already open. So even those traders that watch the opening range on index futures, the first 30 minutes from 9:30 a.m. to 10 a.m. Eastern time, they're watching 30 minutes of action of a market that opened 5 p.m. the previous day. And this is, of course, the key to trading the open. It's not actually the open. There is information that we can use from the Asian and European trading to help us make decisions as the US traders start working. Now, in most futures markets, the US leads in volume, but a lot of the time there is significant volume traded up to that US Open, mostly from Europe. And it's this volume of trading, or rather the positions and liquidity of these traders into the US Open, that provide us with opportunity. Now, this opportunity isn't one you can just jump on once you know what to look for. It requires some practice and understanding of specific market nuance. So if you take all this in today and attempt to trade it on Monday, you might get lucky or you might not, but you probably won't be doing it properly. Okay? Because what you'll be doing is really taking the trade based on all of the elements required, or not, sorry, you'll not be doing it based on all of the elements required, one of which is a little bit of experience in the type of action at the open. So watch the opens for a few weeks or a month and get to understand how it moves before you consider placing a trade at that time. And the good thing about this is most of you are going to be at your screens anyway. So all you've got to do now when the market opens is watch for the things I'm going to show you today for a few weeks or a month, and just decide if you want to do it. So if you jump in and start trying to trade this for the next few days and it doesn't work out, you might well say, well, that was nonsense, and move on to the next thing, and you might give that a 2-day shot. If it does work, you might decide to go all in and then get burnt down the road. And that, of course, would put you in with the majority of aspiring traders, ambitious and keen, but not methodical. So take your time to assess whether this opportunity is something you want to attempt to take advantage of by having a period of observation. Now, I'm telling you this because what I'm showing you is going to look really, really simple, and I don't need to fall into the trap of thinking that that apparent simplicity equates easy money. Now, the first thing you're looking for into the open are areas where lots of traders are positioned as you get close to the open. So we're going to look at the open from August the 13th, 2015, and then note that that is the summertime, obviously, and volume is normally quite poor in August, but we had a lucky summer in 2015 in terms of volume. So at that point, volume was decent, and we'll come to why that's significant a little later on. Okay, so what are we looking at here? Because some of you are going to say, well, where's the chart? Now, bear with me, because that's not where the opportunity is. In fact, that's why a lot of people say don't trade the open, because they're actually looking in the wrong place at the open. So what we have here, we have the jigsaw dome, and the key things that we're going to be looking at here, first of all, the time. We can actually see it's 5 seconds before the open. The third column here is the volume profile. That's just the number of contracts traded at each price. Now we can see we have significantly more volume traded from 64.50 to 65.75, and that's just above where we're currently trading. We're currently trading 64.25. We also have higher volume at 63.50 to 63.75 below us too. And that volume represents traders' positions, a place we can say that a lot of trading took place. And of course, that doesn't mean that all the people that traded there are still positioned right now. You know, you can say that about any price, but relatively speaking, there will be more positions in these areas, especially because we're still trading close to it. Now, what we can assume is the closer those positions are to current price, the less likely they will have been stopped out. So if we imagine a trader short at this point from 58.50, he's less likely to still be in the market and less likely to react when we get back down there because of how much we've moved away from his price. Now, volume does taper off as we move up through the range, and you could have an argument that says, well, maybe we should consider, this 66 here as the volume, top of our box, because there's a just a few hundred less there. But basically what we're looking at the higher volume areas. It's not an exact science. It's more of an art, but we're just saying, okay, where's the bulk of the volume? Now, the inner blue and red columns are the market depths. Those are the people with limit orders waiting for someone to come and trade with them. So you can see, apart from down here at 62.75, the amount of limit orders is quite insignificant. Now, that doesn't mean there's no liquidity there. It just means traders aren't showing their hand. And so we're going to make some presumptions about where liquidity actually resides based on where the most trades occurred. Now, for those that don't understand the term liquidity, it just really means where the limit orders are, or where people are sitting waiting for market orders to come and trade them. And here's the open. So one of the things I do here at the open is I clear the volume profile. So this is the overnight volume profile, and then when I get the open, I like to clear it down. So now in this volume profile, we're just looking at the trades after 9:30. Now these inner columns here show us the number of contracts traded this time round. Okay, so we do see a discrepancy. We're going to see a discrepancy between these inner columns and what trades on the volume profile. Okay, so don't get confused by that. So we can see that, from the open, basically, we didn't move up. We were trading 64.25 just before the open, and we traded up to 64.50. So effectively, we didn't trade up because we were bid 64.25, offered 64.50. We traded a little more at 64.50, and then we went down. So in effect, before the open and at the open, we couldn't get into this high volume zone and trade it. And that's a shorting opportunity. But the thing is, in this case, it's a shorting opportunity that you would have had to be extremely fast to take advantage of. Now, we can see that as we got through 62.75, remember over here we had the large bids, we can see that liquidity was actually real because 1,054 contracts traded as we went through that price. But there's still no significant liquidity anywhere. But what we can say is that the long traders at 63 to 63.75, probably at this point, not part of the picture anymore. Okay, so where do we go next? So the next thing we do is we move up to the top of this high volume area. Now again, there is no evidence, if we look above here, there is no evidence that there is significant liquidity or limit orders anywhere above us because the volume is just not there, okay? It's just very, very average. Although we might say below us, 63.25 might be a slight concern because we did trade slightly above average volume there, okay? Now this zero here at 65.50 shows that we moved up to the price, but we couldn't trade a single contract there. So we're still actually in the first minute of trading here, and the rejection up here around the high of this volume area is exactly what we need to see to take advantage of this opportunity. Now, take a mental note of the low. It's 2062, and we've traded 15 contracts there. Okay, and this is where we are 4 minutes later. So what we've done, we traveled to the top of the high volume area we marked before the open. It's been rejected. On the way down, we had two prices we'd have been concerned about. The first, and you have to remember this, really try and remember this, if you remember anything from today, is the open price. Simply because lots and lots of traders have their eye on the open price, okay? It's a pivotal price for intraday traders. Okay, the other price that we'd have been interested in or wary of, yeah, so it's a hurdle effectively, was 2062, because as we swung up, the 2062 was the low, and when we came back through the low, we can see indeed as we traded through the low, we traded 1,580 contracts there, and then it broke down. So there was liquidity at 2062, but it couldn't hold. And so once you're in one of these opportunities, you're looking for hurdles. Okay, I'm short. What are the hurdles? Well, the open price is going to be a hurdle. The current low of the day is going to be a hurdle. So how would you play an opportunity like this? Well, one of the ways you could play this is you could just put limit orders at the extremes or a tick or two short of the extreme of that high volume area, because you won't get filled at the extreme. So if you put an order in at 65.75 and that is going to hold, you won't get a fill there. Okay. The other way to play this is to wait for the rejection but get in quickly. Okay. So we had an initial push down off the bottom of the range, okay, when we started 64.50, and that would have been very hard to play. But on the retest, as it came up to the high of the volume zone, we had a clear rejection and time to get in, even though it was only a minute into the open. Now sometimes the rejection is really fast, and that's where the skill comes in, both in terms of taking the trade and then exiting quickly if it doesn't work out. So here we are on the 11th of June, and what we can see, we've got two areas of high volume. So we've got 850 to 09 and 05 to 06. And we can see that leading up to the open, we basically dropped down from 2107 to trade down here at 2104 just before the open. So right above us, as we come into the open, we've got this 05 to 06 area of significantly higher volume. In this case, it's much clearer. The areas of high volume are very, very well defined, and the steps in the volume profile are very clear. And by steps, I just mean these areas where you've got like 10,000 contracts here and 3,000 contracts there. That's called a step in the profile. Those are the areas that can act as support and resistance. Now, obviously, with a trade like this, you need to be fairly fast getting in. Okay, we opened at 0450. We traded briefly at 0475. Okay, up to here. And then the market dropped. Now, partly the drop, this big drop here, the reason it dropped so kind of dramatically there, it's these guys getting stopped out, and that's the reason for taking this trade. You're looking at these people defending their positions or getting stopped out and trying to get on the right side of that. So you need to be fairly fast getting in. It's going to move fast away from this area because of the stops, and you need to be equally fast if the price comes back at you, because these are not trades where you allow large stops. Okay, this trade, if it moves against you 3 or 4 ticks, you get out. This isn't the kind of trade where you give it 2 points to come down, because if it moves 2 points away, you've effectively washed out that volume anyway. So for me, in this case, you know, if you'd gone short at 0450 or 04, anything above 2106, the premise for your trade is over. So that's where your own trade management, your own analysis, your own risk profile comes into it. You know, make your observations about your market, how much leeway you need to give these trades. So you may well need to allow extra ticks in your stop, just depending on how volatile your market is. And as we've seen this week, volatility is not a constant. Okay, so we've seen very volatile week this week. So you've got to make sure that as volatility changes, you make adjustments. Now, I scale out of trades personally, and I know that's not for everybody, but on a trade like this, I want to try and get 4 ticks on my first scale. So I'm expecting a rapid rejection, and if I don't get my first 4 tick scale, I just want to get out of break even, it comes back at me. And that's a personal preference, it's not the only way to trade it. But saying that, I won't even get in if I can't get a good price. So in this case, if I couldn't get in at 0425 or above, I'm not going to get in. So because sometimes the follow through on these trades is fantastic, sometimes it's useless, and you just have to cut the trade. So insisting on a decent price on the entry gives you more time to manage the exit on the loser. It gives you more breathing room in a trade. Okay, another one from earlier this year. This is actually from March. And again, it's very, very clear in the volume profile that we have significant positions from 1025 to 1075. So we actually end up opening at 21.1150, okay, right here. And we trade right off the open up to 12.50. Then we swiftly drop to 21.10, but we can't make it any further down. So effectively we've dropped and just traded here, okay? We've moved up, we've dropped at the bottom of the high volume node. Couldn't make it any further down. So the longs in this high volume area are holding the market, and this trade is one where you would have had plenty of time to make a decision. Price push down, a tick through the high volume area, and then it moved up. But saying that, there wasn't a lot of profit in the trade. So you could have realistically got 7 ticks out of that trade there. You wouldn't have sat through this as it moved down there, but you could have got 7 ticks on that trade. And that's why I scale out, because I want to catch something on the trades where the reaction is just a minor one, and you don't have to be rigid. So I'm not rigid with scaling out. So I'll normally scale out 4 ticks, 8 ticks, 12 ticks, 16 ticks. But you often see with moves like this, it just doesn't have the momentum. And then you take the rest of your position off. So you might actually be scaling out your first scale at 4 ticks, and then you can see you lose momentum, so you just exit the whole position at 5 or 6 ticks. So best case is 4 ticks, 8 ticks, 12 ticks and so on for me personally. Worst case doesn't have to be 4 ticks and then 0 on the rest. Okay, so if you see the trade failing, I try and take some profit on the rest. Okay, and you'll find that each different market kind of runs in a different way. So we know that when the ES moves away from the open, it can tend to put in a good run. That first swing on the ES can be a really nice swing, and probably often is the best swing of the day. Now, discipline is important here, because if you're the kind of person who kind of trades on hope, the rabbit in the headlight that stays in trades, hoping it'll actually turn around when the evidence is to the contrary, this is something you don't even want to attempt, because you just can't. As soon as these trades move against you, you've just got to cut them. So the very simple guidelines for these trades: first of all, look for high volume areas close to the open. Look for order flow to confirm that this price is holding or this price has been rejected, and then get out of the trade if it doesn't swiftly move your way. Now, all days are different, and some days, especially low volume days, the volume profile as you go into the open is going to be less clear. So despite last year being generally good in terms of summertime volume, August the 14th was very lackluster. It was more the normal sort of summertime action you get. Now, this is a chart, a jigsaw we call the CSI, or the Cumulative Sheep Index, and it's a bit of a joke name, but it shows us something about participation. It maps the current volume against the average volume for the time of day. So at this point, just before the open, we have 86,500 fewer contracts traded than average for the time of day. And this is just looking at back at 60 days worth of data on this. And the rather ugly volume profile here reflects that. So you can see that below here at the bottom, we have an area of higher volume from 74.25 to 75.75, but it's not the 12, 13, 14,000s that we saw on the other days. Now you can see some X's here on the left, and that's just a column on here that lets you put in some comments. So I put in X's to denote areas of high volume. So as I go into the market, it's going to clear my volume profile, and these X's kind of just remind me where the volume was overnight. So I've marked out 74.25 to 75.75, but I've just marked out a few other areas where it's above 5k. Now, why would I mark something that's above 5,000? Because we can see before I'm interested in 10, 12,000. Well, high volume is relative. So on a lower volume Asian or European session, you'd expect a lower volume US session, and I'd also expect it to take less positions and less liquidity to influence the market. So we open at 77.75, where we traded about 5,000 contracts. Then we moved down to 76.75. We just traded 144 contracts and we moved up again. And again, we can see where we moved down to was one of those higher volume areas. Now, we can also see that we traded the 144 contracts, but last time there was 67 contracts. So the difference between these two numbers is basically, this is a total, and this is last time round. And this is significant because it's going to keep coming back to these areas. This isn't just it doesn't generally just hit these extremes once. It'll go to that extreme, come back up a couple of ticks, go back down, have another little look there, there'll be no interest, okay? So it's not just like, goes to my price, boom, I have to get in, okay? So we do get that kind of a little bit of order flow confirming at that price, that lack of willing for anybody to actually hit into that area. Now we move up, come back to 76.50 again, and we're now 1 minute 51 seconds after the open. Okay, we're back to this area once again where these two X's are, looking for this area to hold. Now what we saw 64 contracts trade there. And the market then moved up 5 points. So the 64 contracts trading there was around the 9:32 minute mark. So we already saw once that there wasn't much interest at that level where we traded the 144 contracts. It went through it down there again, just ticked through that price, and again just traded 64 contracts. So for me, that's the signal. Okay, that's the signal, seeing that just lack of willing. So that's where I'd get in, and if it comes back and starts trading down here, even just a few 2 or 3 ticks down, I'll just exit the trade. I don't need to be in this trade, right? I need this trade to work out immediately. I don't need to be offside in this trade. Now the next interesting thing is where we actually traded up to. We got up to our next zone and we reversed back off it. Now we hit the 81.50 mark here around 9:36, and we saw that 81.75 has got 0, so that means it was offered but nobody wanted to trade it. And again, we could have taken a short as it moved away from there. Just bearing in mind that once it's moved 5 or 6 ticks from the top of that zone, if it moves 5 or 6 ticks down before we get in, I'd consider that personally too far to get an entry. But this is a volatile instrument. It could move down 5 or 6 ticks and then come back up and give you a nice entry, maybe here at 2081. So have a bit of patience with this. Don't just jump in. Don't see it move down and say, okay, now it's not a good price, but I'm going to get in anyway because I think it's going to go. Let it come back, get yourself a good price, and then you'll be in a much more comfortable trade, because it's probably going to come back and give you that opportunity for a good price anyway. So you don't want to be in a short at 80 when it's going to probably come back and have a little peak up to 81.25. Let's move on to another day. So this is August the 18th. Now this was an interesting day because despite the low volume into the open, we got the whole thing with 67,000 contracts below average. This is just a few seconds before the open. I took this screenshot. We clearly have an area of high volume from 93.50 to 94.25, or you could potentially include 94.50 if you want. It's much more pronounced than the prior slide. So the probabilities are actually higher. Now the volume does taper off at the top, but we can really see that this area is where the high volume is. And maybe you could also look at 95.75 to 96.25 also does have higher volume there. And this is just before the open, and we can see we open here at 96.25, so just where that upper area is. Now we move down from there again, and again you'd have had to been really fast and really quite brave to have actually shorted that right off the open. So generally you find that initial move off the open, it kind of happens in an instant. I'm not suggesting that you take that, because trading early is one thing, but trading 2 seconds after the open is another thing entirely. There is zero chance of any confirmation within the first 1 or 2 seconds. Now where we get down to 94.50. So if you look at the volume at 94.50, you can see 85 contracts traded. If you look at this 4 here, you can see that 4 contracts traded, and that 4 is what traded last time round. So what this is showing us, it's showing us we hit 94.50 a couple of times. Now it doesn't matter what you're using, unless you're using like a 1 second chart. A lot of the time you're going to miss the fact that it's hit that price a couple of times unless you're actually watching it. So you can go back and look at charts, but you're going to have to be looking at a really small time frame to see that this hit this price a number of times, but we can just see it there by the volume. So last time we came down here 4 contracts, and that's interesting because it's when it comes back and doesn't want to trade that we have the good opportunity. Now I didn't take that trade when it first came down to 94.50, but rather I saw it go down to 94.50, bounce up a few ticks, move down again to test it, and basically that's where I got into the market. And that was about 30 seconds into the open. Now, there's no reason to say you have to do this my way. You might actually look at this, watch the market, and actually find a much better way to trade this than me. Now, you could have had a resting order in at 45.75 looking for this to hold. But on trades like this, for me, if you put an order at 45.50 or 94.50, sorry, the chance of getting filled on it almost zero. So, I like to get down, see it, give me some confirmation, and then whack into the market on a market order, basically. So we got an entry at 94.50, and it's already gone past the area where the first scale out is. And unfortunately, this is one of those times where it didn't turn into a runner, but we did get an initial reaction. And this is what happened next. So we did move up to 97.75, and then we fell back down. This time we fell back down to the bottom of the zone. And that's when I took the second trade. So the first trade was along at 94.75. We went up through to 97.75, came back down. On the way back down, I got out, basically. So I got two scales, got out on the way back down. As we came down again, sort of very similar thing happened, came back down to this price, didn't really see a lot of willing to trade. So we can see 2,228 contracts traded into 93.75. It took a couple of attempts at 93.50. We just traded 65 contracts. So I got in. I didn't get the price above this time. I didn't get the 93.75. I got a slightly poorer price. But again, that was a decent trade. That was at 9.42. Okay. Now the first target at 95 was hit in just a few seconds, and that is quite normal. But that's all we got out of the trade. So after that first target, what I do is I put in a break-even stop. It's one of my rules. If I get to my first target, I put a break-even stop on the rest. If I actually get to the second target, I will sometimes loosen that off a little bit. Now we can see that we eventually moved down to 92.75. This is about 10 minutes after I took the trade, and then the day started to settle into range, which is pretty normal for a lower volume day. So not all trades work out, and not all days start with that big swing off the open. Sometimes the trades work out, they just don't have the legs, they just don't have the pace. So you need to be nimble at getting in and out, and that's why I say you need to watch quite a few opens. So it's much more important to understand how to handle the trades where it comes back at you than the ones that go your way. That's where the skill comes into it. Now, it's not rocket science, but it certainly is a skill. So you should expect to suck at this if you actually give it a go when you first start. So simply put, volume builds before the US Open in many markets. The more volume in those areas, the better. It's more positions, it's more liquidity. Don't expect the liquidity to be visible as limit orders on the dome, okay? This is purely about the flow of orders and where the positions were. So your entries are refined with order flow, or rather, I'll say that in my case, the entries are refined with order flow, because that's not necessarily written in stone, okay? But the order flow signal you see the most often is a lack of willing to trade at a price. So you're actually trading a relative absence of order flow. Now, of course, sometimes you'll go down to price, limit orders will step in, hold the market, but in my experience, that's the exception more than the rule for these kinds of trades. Now, the closer you are to an area of high volume just before the open, the better. But that also means the move is going to happen faster, and you might need to take it second time round. So sometimes it literally opens on the edge of high volume, stays there for 1 second and moves away. And I've never found a way to trade those. They're just too fast for me. Now, as you move further from those higher volume areas, the chances of people positioned there still being in the market are much lower. Now, the smaller the range of prices in that high volume area, the better. So the areas are more obvious, the steps are more pronounced, and there is no ambiguity about where the boundaries are, and your stop out point is also much closer. Now, there's no need for you to jump on the S&P 500 just because that's what you saw here. There's lots of markets to trade. There's energy, there's agriculture, there's interest rates, metals. You actually might find another market that's easier to trade this setup. I don't. I stick with the S&P 500. I actually came across this setup because I was just sitting there anyway and watching it every day, and I kept seeing this going over and over again, but I'd convinced myself that this was not something that was safe to do. and I was watching it over and over again. And at some point, I just said, look, you should at least try. Just throw some one lots at it. So you could do the same thing with other markets. You could pick up, you could go and look at corn and do that. You could go and look at, if you look at where you got a crude oil open, you've got a US interest rate futures open, you've got the stock market open, and then you've got the grains open. So you've got 4 opens just in the morning of the US. Now, some markets are a no-go. So Eurex futures really do close. So there's no overnight volume for European traders to look at. There is the London Open, where volume picks up, but you've only got an hour of trading from Frankfurt, which, to be honest, is really low volume, can be really, really slow. So really, Eurex is out. Ideally, US markets that trade during the Asian and the European session are the best. So get to know the market and when you should and shouldn't trade it, what sort of volume is appropriate, what sort of volume doesn't really elicit a reaction. And then you have to figure out your trade management. So all in, all out for a small target is not a bad approach. But there's no reason you can't scale in or scale out. I prefer to scale out. So the chosen method will most likely impact which trades you can take. So if the other side of high volume is 7 ticks from your entry point, then your 4 ticks all out target wouldn't make a lot of sense for that specific trade because you've got 7 ticks of risk. Now, if you've got any questions, it would be a good opportunity to start typing those in now. This slide is self-explanatory, but I'll let that sink in a minute. We all know about the rabbit in the headlights. You're driving along, you see the rabbit in the headlights, and he just stares at the headlights and watches the car come, and he becomes a flat rabbit. Well, there's a lot of people that trade are like that. And if you're the rabbit in the headlight when a trade starts to move against you, you can't do this kind of trading. You'd be better off if you're the more nervous type that closes out too early, because these trades probably will benefit from you doing that. Now, for many of you, this sort of trading is going to be pretty much a million miles away from what you've been told trading is all about. So we didn't use any charts for the entry. We just played off the locations where traders were positioned. Now, that doesn't mean you can't use charts to trade off. So this is just the start of the trading day, and this is just an approach to take advantage of the positions that are set up overnight to use into the open. So it's just a single technique you can use at the open when you're going to be sitting there anyway, and this is the most appropriate information to use at that time. Now, the tools you saw on the screen, they are part of the Jigsaw Trading Toolset. If you want to know more about Jigsaw Trading and why we're the #1 trading software company on investtestimonials.com, take a look at our website. You'll see lots of details about our trading tools, as well as a lot more educational material completely free of charge. In fact, the video of this presentation will be on there. There is a free order flow foundation course on there, and it's being used by professional trading firms in Australia and the UK to teach their intern traders. And again, that's partly because the material is quite good and partly because the instructors are lazy. Okay, so right at this point, I think that slide is self-explanatory. Do we have any questions? Let me just go and have a look. Okay. Okay, so go on, sorry.
It's all right. I was just jumping in, seeing how you're doing. I do see a couple of questions. If you want, I can moderate them for you. If you want, I know you're in the chat room and you see them, so up to you. How you
can read. If you can read them out, I'd love to give my voice a little rest.
All right, I hear you. All right, so to start it off here at the top, this is Sakis F111. He's asking, is OEC Trader necessary for Jigsaw when using Sierra, or any way to avoid it?
Right now it is, yeah, but we're kind of working on that. But right now the only way to use Jigsaw with Sierra is using OEC as a feed.
Alrighty. OS Trader asking, when would be the best time to start trading the E-mini S&P 500? I was thinking the actual stock market opens. Sometimes I try for earlier.
Well, I think, from what I can see, you could start. It's a real shame. I mean, I have a lot of people contact me and say, look, I'm in the US. I've got an office job. I'd like to trade when I get home, and it's a really tough opportunity. I think from when London opens, it's good. Okay, so you know, volume is good at 5 a.m. Eastern time. You know, 8 o'clock in the morning is a great time to trade. So this opportunity starts at 9:30, but it doesn't mean there isn't good trading earlier on. I personally trade a specific way, which is really about trying to piggyback lots and lots of momentum of speculative traders. So I personally prefer to trade after 9:30, but the market's got a lot of volume earlier in the day. I mean, if you're trading at 8 a.m. Eastern or 7 a.m. Eastern, it's a good market to trade.
I would agree. Thanks, Peter. Let's see, Igor A. He's asking. I guess this goes back to your ladder, or your dome. He's asking, enter where on an empty cell. So I guess.
Well, these things. Okay, so these columns in the middle, they're what we call current trades, which means what hit into the market last time round. So when he says an empty cell, you can see that as we moved up there, this cell is empty, which basically means it's come back down. And it's showing you what's trading this time round. So if it's showing you what's trading this time round, when it gets there next time round, it actually clears out. So what this says is, you know, we ticked up and then we back ticked and we didn't trade anything. It's an empty cell. You know, in this case, we just traded 2. I would say you don't necessarily need an empty cell, but basically low volume. I want to see it go down to price, trade 12, tick up a couple of times, go back to the area, trade 30, go up a couple of times, come back to the area, trade 5 or 0. Then I'd like to get in. So an empty cell is kind of a more visual signal, but I think low volume is enough.
All right, thanks, Peter. Just a comment here from Jay Trades. He's saying, amazing presentation, Peter. Thanks a lot. I'm loving your work every time I listen to you. Couldn't agree more myself. And certainly an excellent presentation. So thanks, Peter. All right, so BV asking, can we get another look at the discretionary rules slide? So I guess just wants to take one more look at that slide if you still got it there.
There it is. It's up now.
All right, so we'll leave that up for a little bit, and let's see. Neil V asking, for ES, how far is too far from a high value area for it to be worthwhile at the open?
Well, I would say it's difficult because sometimes it'll hold. I think if you're like 10 points away, I would say they're washed out. But you can go and revisit an area of high volume 5 or 6 points up, and it holds. Okay, so some of the things, some of the things we do are kind of self-fulfilling to an extent. So I've never heard of anybody doing this before. It was literally I kept watching. I was just sitting there anyway, and it just kind of like keeps seeing the same thing. So, but for all I know, this could be a lot of people doing this, and that could just be other people marking those levels off, and that's why it's working in some cases. So, if you moved 10 points away, I wouldn't really be interested, and I also wouldn't be interested an hour and a half later. This is first 30 minutes coming back. If we come back an hour or an hour and a half later, I'm probably not going to take the trade.
Alrighty. Let's see here. Elise asking, where did you get that volume profile chart that you used?
That's Jigsaw Trading. That's the software. That's my little company, and that's our software.
Alrighty. Peter H asking, is this recorded now? I know on the Top Step Trader side we're not, but Peter, I thought I heard you say the recording of this will be on your website. So
yeah, barring any technical problems, I've been recording it. I haven't listened to how good it is yet in terms of audio quality, but it should be fine. Yeah, it should be recorded.
All right, and, fair enough. So,
what I'll do is I'll put it on the Jigsaw Trading website. So just go to jigsawtrading.com. It'll be up there somewhere.
Gotcha. All right, appreciate that. DE asking, how do you use difference between the Globex profile and the regular trading hours profile? I have both up always and find that the Globex volume point of control value area highs and lows do get participation as well. Any ideas?
Yeah, I don't use the value highs and lows on Globex just because I've got so many. There's other things that I look at, but there's no reason you can't play off those as well. Because people are trading all the way through. So it's not something I trade off, but I don't see why it wouldn't work.
All right. Let's see here. J Trades saying, I use price action with support and resistance levels. Can your tools and volume profile be a great add to my kind of trading?
Yeah, I mean, basically that's the way I trade. So, if you look at it, I was just setting support and resistance based on the volume profile. But if you look at the prep, I do a daily prep that goes onto the Top Step blog, and you'll see that I'm using part of my prep where I was going today is I look at a 4-hour chart and I look for very, very obvious areas of, where the market turned before. And that's where I trade. What I tend to do though is I look for common areas that I believe lots of people are looking at, and I tend to wait for an area to hold, and once I see it hold and I see there's participation, then I'll wait for it to come back a bit and then get into the market. So that's just kind of my angle on it. I let everybody else do the heavy lifting in terms of turning the market, and then I'll say, okay, well, they've turned the market, now I'll just take advantage of that. But effectively, that's exactly what I'm doing, basically. So that's a definite yes.
Awesome, thanks. Pavin here saying to Peter, is it okay to ignore the Asian, UK data or price action and just consider the market as gap up, gap down when the US opens?
Yeah, I mean, I don't trade gaps. The only time I trade, I will look at something as a gap is if, if we move up and we're above yesterday's high. But I tend to just look for the high volume areas. So I look at the high and the low from the Globex session, but I tend to not worry too much about the gap itself, unless we've moved below yesterday's low. So I don't see the difference between the open at 9:30 and yesterday's settlement as a gap. I see, if we close at 1800 and we open at 1750, that's the gap for me. But I mean, anything's okay basically. But I'm not a gap trader.
Gotcha. Thank you, Peter. Let's see here. Manny Moda just commenting, yeah, see jigsawtrading.com for much good info. So it's good to see, Manny. Question from Logjam asking, are you planning to do anything about the time sessions on OEC Trader? They don't have session templates and it messes up the volume profile a lot.
Yes, I am. But give us about 3 months. That'll be done.
Alrighty. DE got a second question here. I think a comment. Also, how do you break down, say, the first half hour to hour of trade? Opening range, opening balance?
But to be honest, I don't really use that stuff. And again, because the reason is basically I look at the 4-hour chart. I've got the swings from there. I use yesterday's market profile levels. I use the Globex high and low, and I use these volume profile areas. I've basically got enough to keep me busy without bringing in anything else. So I've got a bunch of stuff I look at, and then the other stuff I just kind of ignore, not because it wouldn't work, just because I've got enough to play off, basically.
All right. Let's see here. OS Trader asking, what software is Jigsaw Trading offering on Investimonials?
That's all of our software basically. It's a lifetime license. You get all of the tools. If you go to Jigsaw Trading website, you'll see you'll see the set of tools. We're not actually offering it on Investimonials. It's just an independent review site. I think they've got about 10,000 different products on there, and we're number 2 out of 10,000. And if you've got any questions about what you see on there, you can just give me drop me an email. I'll actually type in my email address into the chat.
Awesome, thank you, Peter. Let's see here. Can Ken G? That must be a joke. Igor A. Entrance where an empty cell. I think we answered that one. I got a question here from T67. Any plans for using Jigsaw with the CTS T4 platform?
Funnily enough, yes. I've had some chats with the guys at CTS. Really, really good, nice guys. Absolutely, we will be doing that.
Awesome, good to hear. Let's see here. Got a question from J Trades, I believe. He says, if I did understand, you try to enter in the prices that are being rejected, trading few contracts each time it touches that price. Why is that so? Well,
there's a couple of reasons. First of all, on the market I trade, the ES, I know a lot of traders call it a second chance market. So if you've ever been in a trade on the ES where you enter and you enter short and then it ticks up and then it comes back to your price, and it ticks up again and it comes back to your price, and it ticks up again and it comes back to your price, and you don't get out, and then next thing you know it blows up. Well, that's the market giving you a second chance to get out, and the ES is very much like that. So just the way the ES moves, it tends to come back and then move away and then come back and move away. And I want to see just, if it comes back to price, nobody wants to sell as it moves down. To get to price, nobody wants to sell it. And it comes down, nobody wants to sell it. There's lots of people watching that. And eventually what happens is they can see there's no selling participation, so people will just start pushing it up with buying. It's just a weakness on the sell side, effectively. And it's just easy to see. You don't want to just see it come to the price just the one time and trade a few contracts. I want to see confirmation. They really don't want to touch this price. So that's why.
Awesome. Yeah, I like that. It's you see the offer get the price get offered or bid, several times, and if no one's hitting it, no one's lifting it. Obviously, there's no interest there. So, excellent explanation. Let's see here. Mark Seflin got a nice comment here saying if you follow Pete's suggestions on his website on how to train your brain to see the auction as it's occurring, you'll start to pick up on the auction patterns. This learning process can take some time though. So he says he likes using the JS platform as well.
Yeah, thanks, Mark.
Let's see here. In the Zone's got a question for you. He's saying, Peter, have you heard of Toby Crabble? I hope I'm saying that right. And his work on the open. He would use a stretch above and below the 1 minute opening range to signal a buy or sell, and use the opposite stretch for a stop. What are your thoughts? I find it works well for after consolidation days.
Yeah, I mean that's the opening range breakout. I mean he's very famous for that. It was the book he regretted releasing. I think he said. It's a valid technique. I've never used it myself. It's not. To be honest, from my opinion is, if I see an area where lots and lots of people are actually doing the same thing, I'll probably try and figure out a way to take advantage of it once I've seen them hold or them get stopped out. So I tend to kind of do the opposite, but I've never used it myself. But it's very, very famous, Tony Crable.
Yeah, I've heard of that trade.
Yeah.
I see it almost every day. I don't play it myself, but it's there. It's definitely there. Let's see here. I've got, I think it was J Trades, just saying another comment from J Trades. Big fan of all your daily prep. Great to know it's going live again, and just want to say thanks to Pete there. Logjam saying thank you, Pete. You're a legend. So I really got some fans today. This is kind of awesome. I like it.
My mom's in the room, I think.
Yeah, she's all the different characters, isn't she? But anyway, No Soup for You got a question here saying, Pete, are you going to do any detailed lessons on your auction Vista functionality and different ways of using it?
Yeah, once my developers stop giving me a headache, I'm going to do that. But yeah, absolutely. I mean, it's a new product. It's in beta. I absolutely need to spend time, and put some presentations together, different things to see. It's a really good tool for thin markets like crude, NASDAQ, the Dow. So yeah, absolutely, I need to do that. It's on my to-do list with a whole bunch of other things like T4 and better Sierra support.
Awesome. I think one last question here. I think I got some late ones if you wanna field them. I know we're just about out of time, so if you gotta go, totally understand. 2 a.m. for Peter, so let's get him some rest.
I'm okay to do a few more. You can cut them off when you have another spot.
All right, gotcha. T67 saying, glad to hear that Jigsaw has plans for a T4 version. How far in the future? Peter, you're saying what, like a few months, right?
T4, I mean, the next major release is about 3 months. It'll probably be 6 months for T4, to be honest.
All right, appreciate that. Let's see here. I want to say there's just maybe one or two more. Oh, Orca Trader saying, I missed the segment. How can I listen to the recording of keys to successfully trading the open? Well, Orca, Peter was saying he's going to have the recording. Granted that there are no technical difficulties, it'll be on his website. I'll post it up. I'll post the website up again here at the end so it doesn't get scrolled. But if you can't wait, it's at jigsawtrading.com. Question from Saki IS again, saying, do you also use the live time and sales information consolidated by time or price other than the one recorded on Jigsaw?
No. no, I never use the regular time and sales.
Default one. All right. MN73 saying, are you going to do do a CSI for Sierra?
Not planned, to be honest. That's not in our plans.
Alrighty. Dale B saying, Pete, a more accurate representation would be to change your picture to a photo of a pint glass.
Yeah, and Dale has actually, I've had more than a few pints with Dale in the past as well, so he's not far off.
Gotcha. Awesome. Well, I think that's just about it here. Don't see any more questions, but we do have Peter on fairly regularly throughout the week, so we're gonna get him on again next week. I'm just checking the schedule here. Let's see here. Usually, I want to say it's Tuesdays and Thursdays, 9:35 a.m. Order Flow Outlook with Peter Davies, Jigsaw Trading. And so yeah, next Tuesday, next Thursday, Peter, if you're available, we'll certainly give you a call, see how you're doing. But I guess that's just about it for today. Incredible presentation. Really appreciate it. Love this opening stuff. I'm a big fan of the opening trade, and I find some of the best opportunities there. So
absolutely.
So yeah, I guess I'll leave it at that. Any final thoughts before I let you go for the day?
Just thanks, Viraj. Thanks, Top Step, and thanks everybody for staying and listening. And have a good weekend.
Oh, thanks again, Peter, and to you as well. If you do go out drinking with Dale, I guess moderate.
I'd have trouble. He's in Florida.
Oh, all right. So it'll be a long plane ride, I guess, if
Absolutely.
you do. But maybe some other time. But either way, Peter, it's always a pleasure. Great to have you on, and we'll talk to you next week. Have a great weekend.
All right, thanks, Viraj.
Take care.